Welcome to the latest episode of our podcast series for financial advisors. Today's episode is The Canadian Wealth Management Perspective, one-on-one with the CEO of $35 billion Wellington-Altus. It's a conversation with Shaun Hauser, founder and CEO of Wellington-Altus Private Wealth. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more.
This is a first for our podcast series. Our content focus has traditionally been on the wealth management industry in the United States. But in this episode, we're heading across our northern border to get a firsthand view of building a wealth management business in Canada. For perspective, Statista reported that in 2024, assets under management by Canada's wealth management firms exceeded a staggering $1.95 trillion in US dollars. That's nearly equal to the country's annual GDP of $2.1 trillion US dollars. To learn more about the industry, the similarities to the US, as well as the differences, we asked the founder and CEO of one of the most successful independent Canadian firms, $35 billion Wellington-Altus Private Wealth, to join us. Shaun Hauser built a career as an investment advisor in Winnipeg before founding Wellington-Altus in 2017. Shaun has a knack for looking at the long term, the very nature of which drove him to launch the independent firm and later take on a private equity partner. I'm excited to talk to Shaun and learn how Wellington-Altus became the hottest firm in Canada in less than 10 years and has been at the epicenter of the nascent Canadian breakaway movement. Plus, we'll dive into the Canadian financial advisory industry and how it compares to the US, including the opportunities and challenges. And Shaun talks about building an independent firm and how they achieved such incredible growth so quickly and the decision of taking on a private equity partner. Even for US financial advisors, Shaun has tons of brilliant takeaways about scaling an idea, how Canadians learn from US trends, and much more. There's a lot to cover, so let's get to it. Shaun, thank you so much for joining us today.
Yeah, it's my pleasure. Really looking forward to talking to you, Louis.
Amazing. This is the first for us. We're delving into the Canadian wealth management market with you as the leader of one of the leading firms in Canada. So I think a lot of our audience is US-based, certainly some folks up in Canada listen as well. But we're going to use this as a educational guide on America's neighbor and try to draw some parallels and helpful insights that any advisor, regardless of what country or province they're in, can take some learnings from. So I'm excited to dive in.
Right on.
Perfect. So why don't you start off by sharing a bit about your background and what led you to a career in wealth management to begin with?
I wish I could articulate it was all part of a plan. It wasn't. So I graduated in 1998 from the University of Manitoba with a Bachelor of Commerce honors degree. I got an interview from my dad's old accountant who was working in a startup called Loring Ward Investment Council, and they were looking for an analyst. I went and I guess I inspired some confidence in my would-be first boss in the fall of 1998. And the rest is, as they say, history. I've stayed in the industry ever since then. You learn a lot about yourself as a young person, as far as maybe you're okay with numbers coming out of school. And I guess for me personally, given that I'm an extrovert, realized that I was dying a slow death if I was just in front of a computer 10 hours a day. So I jumped on the sales path in a different organization a few years in. And then one thing led to another to try to fulfill my entrepreneurial ambitions, which were always inset in me early as a guy. And here we are just under 30 years later, and consider myself very lucky to be part of Wellington-Altus Financial.
Amazing. And before you founded the firm, what are some key experiences that shaped your perspective on the financial advisory space and kind of shifted the way you're thinking about building your own firm?
Well, I think the parallels between Canada and the United States are identical when it comes to the response. The characteristics of the industry are fantastic. And what I learned in my first sales role in my late 20s was, if you give me 1,000 advisors, I'll show you 1,000 different ways to being successful, which I think is a testament to the characteristics of the industry. Like, take a step back for a second, Lewis, and this applies to really every financial advice business on the planet, let alone just Canada and America. Think of the wonderful characteristics that our businesses exude. We have no receivables issue, which is a big deal. I have no raw materials cost of goods sold issue. My top line revenue is, generally speaking, marked to 6 to 8% long-term growth rate, which is multiples ahead of long-term inflation. My number one variable expense is compensation, which correlates to revenue, meaning that when revenue goes down, my number one line item on variable expense goes down commensurate. So there's P&L insulation. And so you take a step back and you look at all these wonderful characteristics of the industry, of the business as a general kind of view, and you realize that it allows anybody that's got a little bit of gusto and a hard work ethic and a penchant for doing what's right versus what's easy to be very successful over short, medium, and long periods of time. I thought that early on, talking with advisors. I think that even more now today. And for me, I just don't see it changing going forward.
So obviously you're very bullish on financial advice, probably across the board, but especially in Canada. Was there an experience you had at a previous employer in a previous role that indicated to you that I really have to build something rather than going to a bank, which tends to be the most common pivot for someone in your role, or joining an existing firm or an existing dealer?
Well, for me, yeah, I come from an entrepreneurial family. So my father's an entrepreneur, my uncle's an entrepreneur, so it's in my blood, so to speak. My father launched a business after he lost his job as an IT project manager, really in my formative years, probably when I was, let's say, 13, 14. And anyway, went on to run and launch a very successful business. I think he had 90 some odd employees when he sold the business. And the impression that left on me as a young person was just the difference in almost personality shift, in that it seemed like he had unlimited energy, seemed happier, was far more productive. Our family benefited obviously from him having larger increases in his income, which is all fine, but that was secondary to just this shift of seemingly like maximizing on his potential as just a person. And I remember thinking very young that whatever you found, that's what I want. And so probably even before I started university, I've always had a penchant for entrepreneurism. And that only grew as I started in the workforce in my early 20s.
So it seemed like it was trying to tap into building something that really drove you. But when or before you started at the firm, were there gaps that you saw in the Canadian financial advice market, or let's put it another way, in the market to service financial advisors, that you said, this is something that I recognize, and if I create something that's a little bit different or something that doesn't exist, this is something that can have some staying power and be successful?
Well, as relates to Wellington-Altus, we started putting together a business plan in 2016. And to your question, Lewis, we saw a lot of atrophied sleepiness in the Canadian market. And I would tell you that I probably am more adamant on that thesis today than I was when we started making the plan in 2016. When you take a step back, there's about 10% of the population in Canada than there is in the United States. Even on a pro rata perspective, you have less competition in wirehouse activity, less competition in commensurate equivalent IC or RIA businesses. You have less competition in independent IBDs, and that's even on a pro rata basis. So we saw a predominantly bank-led, bank-owned industry in Canada, and we thought there was room for what we would consider a viable competitor. In 2016, there was already the migration of wirehouse to RIA assets that we saw. And I don't know if Canada ever gets to the same levels that you're witnessing in the United States, but we knew enough to know that banks in general on both sides of the border have become antiquated because of their size and have become too bureaucratized in how they service advisors. And we thought that had legs for a long period of time. The one mistake I guess we made upon reflection, as I sit here now in 2025, is that we probably underestimated the level of disenfranchised advisors at bank-owned institutions and underestimated the potential that the business, our business anyways, could realize by filling this void in the market that, upon reflection, was much larger than I anticipated in 2016.
Let's take a step back, if you don't mind, and I'll share quickly what my learnings of the Canadian market look like, but please help me fill in the gaps. And I think it'd just be helpful for perspective for those not as indoctrinated on the Canadian financial advisor market. So my understanding is the big six banks, or some say the big five banks in Canada, control, depending upon how you analyze it, anywhere from, say, 80 to 90% of total assets. And they have probably more than double the market share of the four large wirehouses in the US. And at the same time, it's a much more complex and onerous regulatory environment than we have in the United States. And there is a movement in the independent space, but not necessarily, like you said, all that much competition in what we call the independent broker dealer world, or the supported independent world as we do in the US. So can you just help me set the record straight and to share a little bit more zooming out on what the Canadian financial advisor marketplace looks like?
I think generally speaking, you did a great articulation. I think the stats are closer to 2/3 to 70% of every investable dollar are owned by 6 Schedule 1 banks. Schedule 1 is our regulatory banking reference. Yeah, we are heavily regulated. The way that our bank charters work in Canada is it really doesn't invite or even allow foreign competition for retail depository and wealth management services business. And as a byproduct of that, Lewis, you've seen on an inordinate amount of atrophy creep into the system. Here's the problem. How much more can you grow? If you own 70 cents of every dollar, like really, if you start growing any more discernibly and taking even more share of wallet, I think even the regulators in Canada are going to, from a competitive perspective, probably force some divest of some of the banks. So what happens as a byproduct of that is you become an expense-oriented institution. So you can't really grow your top line, but you have to meet a quarterly bump in earnings to the shareholders. And the only way to do that is to become more fixated on the expense side of the equation in your P&L, which means that you're not a vibrant, growing business looking to really power entrepreneurs, which is what our wealth advisor teams are. You're not looking to power entrepreneurs to their dreams. What you're really looking to do is cut corners everywhere, because you can't help these entrepreneurs grow. Because if you do, and you do it too much, then you're going to probably have your hand forced to chop somewhere else. And so you become this backwards looking, expense driven bureaucracy, which really, and you would know this, Lewis, really diametrically opposite behind what entrepreneurs need. Entrepreneurs need someone that kind of looks at the world the same way they do, in helping them get to really big mountains that they want to climb. And it's our job to make those dreams happen, and to make that reality, and to fix problems, and to get out of their way. And we take that really seriously. And I alluded to this earlier, what I probably underestimated was the levels of atrophy inside of the bureaucracy called banks in Canada, and the level to which very successful advisor teams in Canada are disenfranchised. This is a very long tail story, Lewis. It's not short term in nature. I don't see this going away for 10 plus years minimum, maybe longer, maybe a lot longer. And we just want to really work hard to try and inspire advisors to come to a home where their personalities are going to find what they're looking for. And I think we've been wildly successful up until now doing that.
Well said. And we'll get into the Wellington-Altus value proposition because I think it's very novel and interesting to understand. But I'm curious, when you do your analysis on advisor movement in Canada, I would imagine if seven out of $10 are with a big bank, that there has to be a prevailing feeling with advisors on behalf of their clients that there's a flight to safety, that I can only serve my clients if I'm at a bank, or the brand name of a firm is really important. And clearly, if they still retain that level of market share, there's not nearly as many advisors either moving or moving outside of the traditional bank channel. And I know from our experience in the United States, it wasn't until the big banks got a black eye during the financial crisis that it even creeped the door open for advisors to consider the independent world. And then it picked up with more support and capital, with kind of contagion and FOMO, if you will, for advisors wanting to go out and do their own thing. Where do you think that stands in Canada today?
I think FOMO is going to creep into Canada. I don't know if it's going to come from our financial crisis. I think it's going to come from time and just dripping in companies like ours on the mindset of the advisor, because they saw what happened in the United States and they have the same feelings that their American brethren have and had. Just like in the United States, there's going to be wirehouse advisors that just simply need wirehouse brands. There's going to be someone from JP Morgan in the United States that needs the equivalent Morgan Stanley in order for them to feel confident in a value proposition that they've built a business around. And that exists here. And that goes on every day. But the pervasive growing mindset, both in Canada on a delayed effect, but certainly in the United States, is at the end of the day, advisors need to put the client front and center in everything they do, and they need to align with partners that also share that view. And I'm giving you my opinion now. I think a lot of advisors in Canada, and I would argue, Lewis, in the United States, that are jumping from institutional wirehouses into an RIA type environment they can't defend the client anymore against the shareholder of the sponsored wirehouse. They can't keep imposing these NPS scores and cross-selling credit cards and mortgages and lines of credit to clients that don't need it because it's good for what McKinsey told their management team 10 years ago. That stuff doesn't work. And I think I come back to what I alluded to about the disenfranchised mindset of advisors. They have to surround themselves with a partner that's going to put the client first and foremost in the mind of what the client needs, unique to that client, not what's good for the shareholder, but what's good for the client. And the only way to achieve that is to run towards some form of independence so you can do that. And that train of thought manifested into billions and billions of dollars migrating in the United States. And I think that train of thought is creeping its way into Canada. And we're just in early innings of a baseball game to see this unfold the same way it has in the United States the last 10 years in Canada going forward.
I've heard some folks say that they feel like the breakaway advisor movement is maybe 10 years or more behind in Canada than it is in the US. Do you think that's accurate?
Very accurate.
Yeah. So why don't you describe the Wellington-Altus value proposition for advisors? I'm sure it's something you're very passionate about, so I'd love to hear the elevator pitch and what sets you guys apart.
Well, look, it's my opinion that culture trumps strategy 10 out of 10 times. We have both. We probably deem ourselves pioneers in a lot of co-advancement compared to our Canadian contemporary peer group. But I got to tell you, Lewis, if forced into an elevator, and if you ask me for my 10-second, one-sentence reply on why Wellington-Altus, it's remarkably simple. You should join Wellington-Altus because we care about you just like you care about your clients. And what we always like to tell advisors is, look, you're going to join us for a number of really well thought out platforms and products and options we offer your business. They're going to save you a lot of time and probably over time make you a lot of money beyond what you're doing today. So that's why you're going to join us. But you won't remember us for that. You will remember us for how we made you feel. And I want you to take a step back, Lewis. If you think about your very successful business in matching advisors to new homes and new partnerships that align with their emotional interest. Nobody talks about the good old days in quantifiable terms. People only talk about the good old days in qualifiable terms. Put another way, it's how they feel. And really, when you think about it, disenfranchised, very successful advisors and their teams are looking for having the good old days again. And the good old days come down to very simple concepts, like having fun again, like surrounding yourself with people that care about this business like you care about yours, surrounding yourself with people that like having fun at work, surrounding yourself with people that like being at work. And that's what you miss, and that's what you want again. And I feel very grateful and lucky to be part of a business that has that in spades. We are far from perfect. If you're looking for perfection, you will not find it at Wellington-Altus, but we fix problems fast. We rarely make them twice. And the way we view ourselves is to get banana peels out of the advisor's way and let them get back to doing what they're fantastic at. Our job is to make you run faster, not to slow you down. And all of this is all very kind of 30,000 foot, high level, easy stuff to say, Louis, but understand it is not easy to do. So simplifying it, but it is not easy to pull this off. And we work incredibly hard at it.
Talk is cheap. It's how you back it up. Let's zoom into a little bit more specifics. So if a successful advisor team leaves a bank to join Wellington-Altus, what's the structure they're joining you? Are they owning their own business? Are they marketing under their own brand? Are they employed? Are they owners in the company? Do they get paid to move? Like, how does that all look?
Yeah, I'll try to maybe talk American to you just so we can fill the gaps quicker.
I appreciate that. Thank you.
So we would technically be a W-2 structure. So every advisor would be an employee, but they would have ownership of their own books. They would have their own brands in their own books. Part of our incentive offer to join would be heavy share ownership, not just cash, when they join our business. We think shared ownership is the magic elixir that binds left coast to right coast in this country. We live in a big place called Canada. And the only way to get commonality and get what used to be a small company, but now it's a decently sized one, moving with speed and in the same direction with very little pushback is having common goals. Common goals are set forth by having common outcomes, which comes from ownership. And I think we've done a fantastic job in doing that. And it's probably one of our secret sauces that we don't hide. Like I'm talking to you and thousands of people are going to listen to this. So we don't hide from this. We don't not talk about it. We always scratch our heads thinking it's amazing we haven't been copied yet, but we'll continue to do what we do and try to inspire people through a lot of genuine, passionate authenticity and get them seeing the world our way, which is not for everybody, by the way. But when we find somebody that thinks share ownership is a big deal, that being part of something is special is a big deal, which we think we are, then usually the relationship intensifies quickly and they get on board. And the value proposition is one of outworking our competition, caring for you like you care about your clients, and just creating a culture of fun, which remarkably makes you feel like you're in the good old days again, which ironically advisors will give anything for, but many don't even consciously understand what they're looking for when they start talking to us.
Yeah, I think that's right. Sometimes it's, you know it when you see it. I know in our work with advisors in the US or Canada, it all starts with being really strategic about what is it that you're actually looking for. And if someone doesn't know, we'll be the first to tell them you should probably not move, or you really got to figure some stuff out. Because if you just go into a process thinking through, or not really thinking, just taking meetings, you don't really know the bullseye that you're trying to hit. So I think that's a great way to put it. And it is hard to put substance to the fact, I just want it to feel like it used to, pre-financial crisis, pre-Bank of America, pre-merger, pre-whatever. And I expect it's the same in Canada. But it's nice to hear that you have a culture where advisors feel like it's how it used to be in a very positive way.
Absolutely.
And how about some stats and metrics on the business? How large is the firm? How many advisors do you have? And is there a median or a typical advisor that your firm tends to attract?
Well, okay, I'm going to probably give you a 2 weeks old data, which in this place gets antiquated fast, but we're just a hair under 40 billion. We have 120 some odd advisor teams. We have a decently good average sized book. We tend to resonate with highly entrepreneurial advisor teams, which I don't think should shock anyone. We see uptick in our average recruitment goals and realizations every year. Up until 2 years ago, I would say the first two meetings, Lewis, were around the concept of who is Wellington-Altus. Those are gone. We're finding more traction with more teams inside of our prospect funnel that lead us to believe that we'll start to realize even higher per fiscal year sales targets for attracting new advisor teams. And that's really exciting, right? The good news is that we've built a business that's highly scalable. And so there's not a lot of change required for us now to realize that scale. We built a business expecting to be successful. So we're in this enviable position that we started 7.5, well, almost 8 years ago, and we had no legacy tech. And so we got to build something fresh. It made it very easy to be very maneuverable as the world changes before our eyes, and has allowed us and afforded us this ability to be very pliable with how we made some really good key investments a few years ago that allow us to scale up. So it's like our life doesn't really change. All of our effort focus is around two big buckets. We support current advisors with equally as much vigor as we put into finding new ones. And that's a testament to having some scalable infrastructure that allows us to keep going.
Well, first, congratulations on your success. Getting to 40 billion in assets is a major milestone or accomplishment for anyone, but especially a firm that's only been around for less than 8 years. So I have to ask, you mentioned the culture and the demand for what you built being off the charts more than you could have anticipated. What else do you attribute your success to and all that growth? A lot of folks listening, even if they have no interest in Canada, I think it's really helpful to understand how a firm of any type was able to reach scale in a way that you did and in such a quick manner. So I would love to hear your thoughts on the growth of the firm and kind of the playbook for it.
Well, I mean, so we were quite pedantic on our planning. So we planned our work, then we worked our plan in 2016, planning the work. We launched in April 17th of 2017. I hate to oversimplify this, Lewis, but I couldn't be more accurate and truthful in how we got here. If you just reflect on the two things as a human that you can control, which is your attitude and work ethic, it's remarkable what you can accomplish if you stay at it. And I think there's 4 co-founders. I'm one. Charlie Spiring, Todd Dagelman, and myself worked simply incredible hours in the first 2.5 years. I think I averaged 24 to 25 weeks away the first 2 years. I bet you Todd would be the same. Charlie not far behind. We just refused to not let our dream become a reality. And if you're blessed enough to have natural passion in something you believe in, which, myself and my partners have, and you're going to commit to each other that no one's going to outwork you, which we did, and you have an almost dogmatic belief system in share ownership and value proposition that we could drive that's avoiding the country, which we believed and believing more so now, you get all these powerful elements together in this one value proposition inside of a business, and then good stuff's going to happen. Didn't happen overnight. It was a really hard lift in the first few years, but it's just a classic entrepreneurial story, Lewis, that I think has similar tenets of all entrepreneurial stories across all industries since the beginning of time, which is you had some folks that had just a super clear vision and were willing to do anything to realize it and outworked everybody and then got lucky. And that's how we feel, and feel probably even more lucky now than we did then as far as the opportunity that's set before us.
Well said. I love that. You've got to just roll up your sleeves and have the vision, and the rest doesn't take care of itself, but those are the initial building blocks. So I think this might be somewhat of an obvious question, and you've hit on elements of it, but how would you differentiate Wellington-Altus, which is considered an independent firm in Canada, from traditional Canadian financial institutions or banks? What are the key things from the operating model, the custodians, the way you provide investment advice that is a clear differentiator from Royal Bank of Canada or BMO or other firms like it?
Look, first of all, to give the banks credit, there are smart management teams that run these banks. And the management teams are just hampered by the 150 to 200 year success and general ownership of the market from these institutions that have just been around forever and own everything. So even smart management teams are limited by the cards they can play at the card table. Okay. And so if you go look at the output by which banks and our company offer planning and practice management and marketing services and anything you can think of, a lot of these banks offer many similar services that we do, but they don't grow like we do. And so, like, what is the real story? And I think it's a couple things. One, I think we're far more digitally forward than our bank competition. Number one, not even close. Two, I think we have people that consider themselves, and I'm one of them, infrastructure versus bureaucracy. And so infrastructure fits into what an entrepreneur needs when they need it. Bureaucracy force feeds you to fit into what's good for it. Well, in order to manage the size and scope of these to fit in a bank, you must be a bureaucracy. It's a big wheel and we're just all spokes. That's not like that here. So if you're an entrepreneurial advisor at a bank and you need financial planning, check, and you need marketing services, check, and you need access to practice management, check, all of which things we have, and you need it in far more spades than you get it there. And you start to see that you're going to have far more access here, and you're not supported by bureaucracy rather than by people that, you know, are in the field with you. You start to get outsized service support. And then you start to close your eyes and realize you're this advisor at this bank. Man, like all these misconceptions I had about these independents, specifically Wellington-Altus, like they're just wrong. These guys have everything we have plus. And then on top of it, I have more dedicated support in real time that I even thought was possible. And you start to feel overwhelmed that you would be foolish not to look at this. Right? Like the way we always describe it, and I do this playfully with absolute respect, Louis, is this is like living in Russia. Okay. You've read about freedom. You saw it on TV. You know about it in books. You haven't tasted it yet, but you're wondering, is it as good as they say? And the answer is, yeah, our job is to get you to confidence and jump the wall. And when you do, it's way better than you think.
What about let's take an example to try to make it more tangible, lending. So if I'm an advisor at a Canadian financial institution, Scotiabank or a firm like it, I can offer my client mortgages, credit cards, checking accounts, really any type of lending solution through the bank. Some would say that having everything under one roof is helpful, right? It's an integrated experience. The lines of demarcation are clear, et cetera. How would Wellington-Altus look to help the same client of the same advisor with lending? How do they access it?
Well, the only folks that say it's advantageous to have it all under one roof are the guys that own the roof. So lending is a great example. We have a lot of cross guarantees with very successful business owners in a lot of our investment accounts. And when you work for a bank, you're allowed to deal with that bank. This is the best. We set up before they even join. So we're very thorough in assessing on a no names basis clients that, you know, have lending needs. And we will go proactively shop them with all banks to get the best rates possible. Have yet to come across a circumstance where we could not find the advisor for their client better rates. And ironically, and this is the best, we have found better rates at the bank that they work for in their quotes to us versus what they get.
That's crazy. That's amazing.
Yeah, like you can't make this stuff up, Louis. Sometimes it's just ironic how backwards things can be. You actually get more love if you don't work there versus if you do. Not all the time, sometimes.
And you think that's because the banks know there's competition for, and in this example, a loan, rather than they know if an advisor brings their client, the advisor doesn't have an option, but to show them one option.
Correct.
Very interesting. We see the same dynamic in the United States where RIAs and independents are able to shop the street, if you will, for the best rates and service. There's still instances, though, and I don't know if you've experienced this, where let's say it's a very large loan or something really esoteric, or maybe the bank is going to take not a loss because banks don't like taking losses, but they'll do a loan at a much lower rate because they have the assets on the platform, because they're generating other sources of revenue that maybe an institution that's just seeing this one loan opportunity may not get as competitive on. Have you seen that dynamic play out?
That happens up here. Like no strategy bats 1,000. Our strategy doesn't bat 1,000. There are instances, well, I would even go one step further, Louis. I would argue that there's some institutions that would take a loss to keep the overall client relationship. And that's a business decision that they've made. And so that could happen from time to time. It's very infrequent. And I would say as a percentage terms, it happens less than 2% of the time over all the different transactions that we've done.
Yep.
But it is possible. And I would say could happen in the future.
Yep. Yeah, I'd say it's similar with my experience too. It's a significant minority, but there are certain advisors or certain clients who may benefit from everything under one roof. But the prevailing thinking is competition is good for everyone. It's good for the client, it's good for the advisor, et cetera. Let's dive into what does the competitive landscape for recruiting advisors look like in Canada? If you are lucky enough to find yourself in front of a $500 million advisor who's great, they have a clean compliance record, like what are they typically considering? Like what types of options?
I would say there's a lot of great independent competitors of ours. Our friends at Canaccord CG Wealth do a great job. Our friends at Richardson Wealth do a great job. They're similar sized businesses. They have great management teams. I would say in our recruiting efforts, we historically and typically come up with big teams with the same decision that they're looking at, which is to say, do I want to go to a bank I feel comfortable with, so upgrade my bank experience, or do I want to become the entrepreneur I think I can be? And so it comes down to they're competing with us versus another bank versus us and another independent. That's historically what we found. It comes back down to what you and I talked about earlier in this conversation, which is this tipping point that occurs. And I start to get a sense it's happening here where there's FOMO and there's enough big advisors that have left the bank channel to gone to an independent, whether our business or someone else's, or created their own business. And enough smart advisors are left in the wirehouses thinking, man, life's too short and I want to get back to having fun again. And I see that tipping point just starting here like it did 10 years ago in the US.
How about in a competitive process? I know in the US, the way you're describing Wellington-Altus, it sounds similar to Hightower Advisors when they launched probably around 2015 or so, give or take a couple of years. Actually, it was well before that. I have that wrong. But advisors wanted the comfy confines of being an employee, getting some upfront capital, having an office, having infrastructure. But what tended to happen was advisors got a taste of what real independence meant, and they wanted more of it. And over time, there were more options for advisors to hang their own shingle, whether it was starting their own RIA, which would be equivalent to starting their own registrant or ICPM firm in Canada. Do you see that now where there's a large appetite for advisors coming from a big bank to bypass what you guys are doing? Nothing against you, but just the model itself, and want to truly hang their own shingle, that they want to control the technology decisions, pick their custodians or their clearing firms. Do you see that dynamic playing out, or is the opportunity to do so limited because of some of the regulatory constructs and advisor appetite right now?
Well, ironically, I use a lot of similar professional advisors that Elliot used when he was running Hightower. So you have a probably better understanding of that business than you think. Look, I think there's more business constraints in Canada to allow entrepreneurial driven advisors to actually become entrepreneurs than in the United States. The whole concept of clearing, it's almost free if you have any sort of size and you want to go to Schwab or LPL or whatever and clear your business. It's like the cost of execution is almost free at this point. It is not like that in Canada. It is very hard. You're limited to a couple real big competitors. We don't really have the whole sweep income stuff that's going down in the United States up here. So that's less of a concern, but it's really hard to become the entrepreneur you want to be in Canada versus the United States, Louis. And so how we hold ourselves out is, look, let us do this for you. You focus on what gets you juiced, which is talking to clients and finding new ones, driving peace of mind for your clients, making them feel like that you have their trust. Like that is a really unique skill set that's very hard to find. And our advisors have it in droves. Anything that isn't that, Our job is to get it off their plate and allow these entrepreneurs to grow at clips that even they surprise themselves at as they move forward. I think we're great at it. I think we're elite at it. And because of the antiquated nature of the infrastructure in Canada that simply isn't available, it allows us, I think, an outsized opportunity to capitalize off of these folks that want to be entrepreneurs, probably could if they wanted to allocate their time differently versus maximize their enterprise value and allow us to do the heavy lift and allow them to have the fun.
Well said. And you hit on my next question, which is building enterprise value. So anyone in the US knows, probably most Canadian advisors know too, that the multiples when someone sells their independent business or even transitions firms and goes from one bank to another are bonkers right now. They're off the charts. Is there a similar dynamic in Canada? Like, would a similar size Canadian practice with the same intangibles sell for the same price in Canada as it would as in the US? And
No,
how do Canadian advisors go about monetizing their practices?
I think the monetization process is similar. The multiples are like probably half.
Wow.
And that speaks to just the limited competitive environment. It's our belief that you'll have multiple compression in the US. Like if you just try and measure payback periods on capital, it's probably almost a little out of whack in the US. I say that from a very conservative Canadian perspective. I could be wrong. So I think multiples have generally been consistent here for a long time. We're in most big deals. We don't see multiples going up. Hey, look, we think it's subject to change. It could be, but we just haven't seen that yet.
So does that mean then that the kind of the way a lot of advisors in the US think about going independent is, well, I may not get as much money to change firms, or I may get no money, and I'm going to self-finance my independent business. But I'm doing it because aside from fulfillment and having fun and working in a different way, serving clients with more autonomy, financially, they're doing it because 10 years, 15 years, 20 years from now, when they want to sell, they can sell for generational wealth. If that dynamic is maybe there in Canada, but it's not nearly the same as the US, do you think that means more advisors are apt to take the easier path and go bank to bank or take the retirement plan at their current institution? Like, does the fact that multiples are lower, in other words, impact what you think advisors value or think about in a transition?
I think typical advisor populist mindsets, the majority are looking to not make their life more complicated. That's the majority. I think that applies to both the United States and Canada. However, the minority that are looking to have purpose, right? Because we think the purpose of life is life with purpose. If we're looking at those folks, and those are the folks that we want to inspire, I think the model as it relates to Wellington-Altus specifically is one that will generate beyond expectation wealth for them and their families over the medium and long term.
Well said. My hypothesis is that as private equity firms in the US begin to either get priced out of deals here or there's not enough viable properties, that they'll find their way to Canada, which will likely increase multiples, which means the math or the decision point for someone to make the dollars and cents work for a transition is only going to increase. And I think higher multiples likely means more of an opportunity for a firm like yours because you can get people to buy into what you're doing and do it in a very objective way, which is based upon the exit multiples and potential valuation. That's my uninformed opinion of what could happen.
Sounds smart to me.
So let's talk about how Wellington-Altus is funded. So I know you've had a credit facility with Ares for a while, and I saw in industry press, and this might be false, and you might not be able to comment on it, but you're in the process of selling a minority stake of the firm to a new private equity partner.
Yep.
Can you just talk a little bit about what motivated this decision, and how do you differ between a private equity investor versus access to a credit facility?
Well, when we launched the business, these are leveraged businesses, meaning that, the revenue, you're not in control of how it's going to come in because markets could go up, markets could go down. Case in point, we had COVID. The first 3 months of COVID, scary times because you're having precipitous cuts in market, volatile activity and pricing, and that affects your revenue and so on and so forth. And so when you launch one of these things, being fiscally responsible is paramount to long-term success. It's everything. And so we had a view a few years in that we wanted to finance our business through private equity. We did that. We did a deal with a large family office here in Winnipeg, as well as the Sinosure Group out of Salt Lake City. And we got a very fair deal with both partners. Both are still partners with us today, are fantastic. Inexorably, the most expensive way to finance your business is through private equity. However, private equity allows you to do one thing that all their formal financings will not do, which is play the long game. And so by having the Sinosure Group in the fold, we financed our business through the COVID, financed our business through the 2022 bear market. We doubled our business in COVID. We grew our business double digits in 2022. And all of that is a testament to us playing the long game in spite of short-term market conditions. And feel really lucky that we've done that. So I sit here today, almost 8 years in. We have no net debt. We've grown substantively. We have a lot of really important shareholders to us. We want to do a couple things. We want to bring in another minority partner where it's going to be a secondary deal. So that means all shareholders are going to get a win. We want to validate our share price first and foremost to the street, because the only real knock that our competitors try to poke fun at us in our strategy is that our private held shares are funny money. Well, we're going to change that in a hurry. We then want to also thank all of the advisors that took a chance on us when we had more risk in our model when we were growing. I think people that take on risk early should get rewarded later. And this is a way for us to reward those shareholders. And then what it also does is just validates the enterprise value for the business, as we expect to triple and quadruple that enterprise value over the next 5 to 7 years. And what it does is allows more validity in our corporate development actions on the street to show advisors who haven't had great rides in private share ownership what it can mean when you attach to somebody that knows what they're doing. And so, yeah, it's public knowledge. We released press releases around our intention to seek a minority new partner, and we're just in the crux of that right now. And I'm very looking forward to announcing something really positive over the next few months as things come into focus.
Great. That was such a refreshing answer around the benefits of outside capital. And I agree that it is the most expensive way to fund a business, but there's strategic advantages that only private equity can provide. And I would imagine too, I saw that in August of 2024, you announced the acquisition of Wickham Investment Counsel. And that was an acquisition. It wasn't a team of advisors. So how do you think about M&A and the strategy of it relative to recruiting an advisor or a team of advisors from a bank?
Our version of an RIA would be like a PM business, or it used to be called ICPM business. So we have a different subsidiary business that has about $1 billion in it. We think COVID hurt that business as far as acquisitions. We've put a lot of time and effort in really broadening our talent within that business to allow us to be more proactive in acquisitions. We expect to announce acquisitions in spring and heading into fall with some of the efforts that we've made, even on a short-term basis. I think acquisitions are a more infrequent form of growth for us in Canada versus wirehouse advisor liftouts, but we expect it to be more additive to our overall growth going forward.
Yeah, I see it the same way. Like there's some firms that their entire business is acquiring, others, their entire business is recruiting. But I think both have to be healthy and on the table for firms that really want to get to the next level. And there's certain advantages of each, certain costs related to each, but having a balanced strategy and being open to it tends to make a difference. So let's wrap here. One more question. How do you see Wellington-Altus evolving in the years ahead? What's an initiative or two or innovation that you see on the horizon that's really going to impact and catalyze the business?
I think it's a race towards being a data aggregator leader. I think if you take a step back and you look at the pace of technology evolution, there are things that our business can do today that we couldn't do 10 years ago. And I think it's reasonable to assume there are things 10 years from now we can't do today. Our thesis and narrative around allowing that to come alive in the most meaningful way for advisors is premised off of the concept of data and data aggregation. If you really have a clean, robust, deep set of data on your business, on your advisors, on your clients, it will allow you to capitalize off of technological advancements that you otherwise didn't even think were capable. I'll give you a great example, Louis, and I'm just going to pontificate here for you. I'm not saying this is going to happen, but in theory, there's no reason why this couldn't happen. Okay. Everyone knows about Microsoft Copilot being launched in the latest version of Microsoft Office. And in true Microsoft fashion, they make something part of the ecosystem when it's about 70% ready. And then they get real-time feedback from all the users. And then one or two next iterations of Office comes out. Copilot is an AI generation add-on tool that will be very useful, I think, for all users of Microsoft Office. That's my theory. Okay. If you have a data set, a really deep, dark data set, so we call it, for us, it's data well. Others call it EDAP, or that's an acronym for Electronic Data Analytics Platform. So if you have a data well, if you have a really good, clean set of consistent, stable data, there's nothing theoretically saying that if you have a client meeting coming up, you just go on Office and you ask Copilot to go make you a household view of your next client coming in with JIP certified returns, and you like an amount chart and you like the color blue and you want deposits and withdrawals identified. There's nothing saying that if Copilot can't look at a data set, that it can't then use PowerPoint to create for you in real time. And that 10 years ago would seem like a dream. And 10 years ago and even today would cost tens of millions of dollars and years of programming to make come to life. And I think all that goes away in the future, subject to you having sources of data that you can run your business off of. And I would say we've had really strong narratives around that for the last 5 years. We invest millions of dollars and tons of time with our partners at Amazon Web Services to curate ours. It's proven to be beneficial, or like in many instances, around our technology stack. And in our opinion, we think we're just scratching the surface.
So it sounds like if you have the data, you can use external AI tools that anyone can use to make the biggest impact. Is that accurate?
Yeah. And that's based on what we know today. I promise you, Louis, in 3 years from now, we'll be talking about something we don't even know exists today.
It's probably right. It's scary, but it's true. Shaun, I really appreciate you coming on today. Our first Canadian guest. I learned a lot just about the dynamics of the Canadian financial advisor market, some of the parallels within the US, but it's always refreshing to hear from a successful founder who especially is running a relatively young company and has so much success. So we'll have to do this again in 3 years when whatever this thing we don't know about is really taking shape, and hear about how Wellington-Altus is well over 100 billion in assets, no doubt at the time.
Well, I appreciate that, Louis. Thanks very much. It was really fun spending time with you today.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.